Okay, it's March 13th, 2026. Welcome to the Cross Asset Market Pulse. Right now, the market isn't being driven by the usual economic data cycle. We're in a geopolitical regime, and we're going to break down its structure, step by step.
So, what do we mean by that? Well, this environment isn't about parsing the latest jobs number. It's a geopolitical macro regime, and it has a single dominant force driving everything. The mood right now is defined by one word: caution. All the pressure is coming from the energy sector, and that pressure is rippling out across the entire asset landscape. It's making markets extremely sensitive to every little move in Treasury yields.
Now, to navigate a regime like this, you have to understand the precise mechanism at work. There's a very clear causal chain that's driving asset prices. Let's walk through the sequence. This five-step sequence is absolutely key. It starts with an energy shock. That shock immediately fuels higher inflation expectations, which in turn forces Treasury yields to climb. Then, those higher yields, combined with a general risk-off sentiment, strengthen the US dollar. And the final outcome? You get increased fragility in the equity market. Understanding this flow is critical if you want to anticipate where things are headed. Okay, so let's look at the evidence. We're going to examine what's happening across different asset classes, and you'll see how each one connects right back to this core causal chain. And the chain really starts right here with energy. The Brent index is staying elevated, which reflects crude prices sitting north of $100 a barrel. Now, the main driver for this is a pretty significant supply risk premium coming from disruptions in the Persian Gulf. This is the ignition point for those higher inflation expectations we're seeing everywhere. Next up is the bond market, which is acting as the key transmission mechanism. Yields are up as a direct result of those inflation fears. The 10-year Treasury yield, sitting at 4.21%, has become the critical benchmark. It's what's driving performance, or, underperformance, in pretty much every other asset. So with higher yields and a risk-off mood, who's the main beneficiary? It's the US dollar. You can see it in the DXY index. Now, this dollar strength creates direct headwinds for everyone else. Commodities that are priced in dollars get more expensive around the world, and any returns from international stocks get watered down when you convert them back to USD. The downstream effects are becoming really clear. Equities are showing weakness because those higher yields mean higher financing costs, and they also discount future earnings more heavily. Gold is also feeling the pressure. Despite all the geopolitical tension, which should be supportive, the strong dollar and high real yields are putting a cap on its upside. The one notable outlier in all of this is Bitcoin. It's holding up pretty resiliently above some key technical levels. And this suggests that, at least for now, it's behaving like a quasi-resilient risk asset, which is a big divergence from the broader weakness we're seeing in traditional stocks. All right, let's try to quantify this environment by looking at some key risk metrics. This will give us a quick snapshot of the current state of tension in the markets. These are the critical reference points that you need to be watching. The Brent index is still elevated. The DXY is firm above 104. The 10-year yield is holding its ground above 4%. And as we said, Bitcoin continues to show resilience. These are the levels to monitor for any shift in the current regime. So the risk dashboard is essentially flashing yellow. The VIX is up, bond volatility just won't come down, and market liquidity is getting thinner as yields rise. That combination points to a pretty fragile environment where the risk of just getting your trades done is much higher. So now that we've established the current state of play, let's turn our attention to what's next. What are the forward-looking catalysts that traders really need to be monitoring? These four relationships pretty much define the current market playbook. You should expect energy to keep driving inflation, yields to continue putting pressure on growth assets, the dollar to act as a headwind for gold, and all this macro uncertainty to maintain fragility across risk assets in general. Looking ahead, it really comes down to three things. First, any geopolitical development that could impact the supply of energy. Second, any kind of shift in guidance from central banks about their tolerance for inflation and high yields. And third, just the direction of broad risk sentiment, which you can see in equities and crypto. These are the triggers that could either reinforce this chain or break it. And this brings us to what is probably the single most important takeaway for anyone active in these markets. In this specific regime, your mindset has to shift. Your analysis has to begin with energy, because that's the primary input. The standard economic data has become secondary to the geopolitical reality of energy. So, to summarize it all, the energy shock is the definitive starting point for everything we're seeing. Yields and the dollar are the key channels that transmit that pressure to other assets. And in this kind of environment, a cross-asset framework isn't just optional, it's absolutely essential. And that leads us to the final question. Now that we've established this causal chain, where is the primary risk from here? Is it simply an acceleration of the same chain, a further spike in oil and yields? Or is the real risk an unforeseen event that comes out of left field and breaks this chain entirely, introducing a whole new regime?